Hi, I'm Kara Murphy, and this is Money with Murphy. Over the weekend, the U.S. conducted targeted strikes in Iran, raising tensions in the region. So, what does this mean for U.S. investors? Several indicators we closely monitor suggest markets are becoming more concerned about the possibility of a prolonged conflict. That said, history tells us that market volatility tied to geopolitical events is often relatively short-lived. So let's start with oil and natural gas. Since the start of the year, Brent crude oil has climbed from about $60 to nearly $85 a barrel, an increase of almost 40%. That move suggests markets are pricing in the risk that this conflict could disrupt oil supply for an extended period. Natural gas prices, meanwhile, are roughly flat year to date despite these disruptions. Next, equity markets. In the 2 trading days following the strikes, stocks across the US, Europe, and Asia all declined, reflecting heightened global uncertainty. Asian markets were hit the hardest, as many of those economies are significant importers of oil. Sector performance also tells an important story. Travel and leisure, banks, and auto stocks have all lagged on concerns that a prolonged conflict could slow tourism and push inflation higher. On the other hand, energy and defense stocks have outperformed. Now, let's look at volatility. The CBOE Volatility Index, otherwise known as the VIX, measures how much movement investors expect in the stock market. While the VIX has risen modestly this year, it remains well below levels seen during prior periods of stress, including last year's major tariff announcement and the COVID outbreak. So how have markets historically reacted to major geopolitical events? While this situation remains fluid, history does provide some useful perspective. In past shocks, U.S. markets have tended to follow a familiar pattern: an initial negative reaction followed by a slow, focusing return on economic fundamentals. And we've seen this play out during events like the Gulf War, the North Korean missile crisis, and Russia's invasion of Ukraine. Looking across dozens of major geopolitical shocks since 1940, the S&P 500's average return 1 month after the event has been roughly flat to slightly negative. By 6 to 12 months out, returns have historically been positive, and then 2 years out, markets have been higher in roughly 70% of cases, with average gains in the mid-teens percentage rates. So why don't U.S. markets react more sharply? The U.S. is uniquely insulated compared to many other economies. Our geographic position, combined with large, diverse, largely self-sufficient economy, reduces our reliance on foreign demand, foreign energy, and single trade routes. As a result, geopolitical shocks abroad have a harder time causing lasting damage to U.S. economic activity. The main risk to U.S. consumers in situations like this is a sharp and sustained rise in commodity prices, particularly oil. Higher oil prices for an extended period of time pressures household budgets, slows consumer spending, and weighs on economic growth. We saw this during the oil shocks of the 1970s and early 80s. The difference today is that U.S. is now a net exporter of oil, which significantly reduces our vulnerability to global supply disruptions. Even if higher oil prices are hard on consumers, American companies that sell oil actually benefit from higher prices. Taken together, markets appear to be acknowledging the risks, but not pricing in a severe or long-lasting disruption. We'll continue to keep a close eye on developments, and until next time, invest wisely and live richly.